Welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thank you for joining us for our May 18th edition of Market Insights and Observations. We're going to talk about three topics: moving the market, and also what you should be watching, because we are too. Thanks for watching. So our first topic of the day is debt ceiling. We're going to talk about that, the U.S. housing update. We got some housing data we can report on, and obviously what we're watching and what we're going to pay attention to moving forward. But let's start off with housing right away with the U.S. housing data. Basically starting to tick a little bit higher. We did see in the housing starts rose 2.2% month over month in April, but permits fell 1.5%, as well as mortgage applications, obviously, because mortgage rates are still a little too high. But ultimately, the bottom line is that housing, let me see if I can do this here for you and get the highlight. The bottom line is that housing data has weakened substantially, which we saw. But it's showing signs of bottoming in the recent months. And so the economic growth, the GDP, a large component to that is U.S. housing data. And it's tracking estimates for the second quarter real GDP to be positive, because housing is not falling out of bed, but it's weakened substantially in some cases, in some areas. Again, real estate's all about the locality, right? Location, location, location. And I'm going to show you that in a couple more slides, specifically what markets have been most impacted versus what markets, again, are actually doing double-digit returns, super hot. So we'll talk about that in just a minute. But there also could be more cracks in the housing market if we don't have a resolution on the debt ceiling. So it's a self-inflicted wound. We'll see in the next week and a half how this plays out. Housing starts right now seem to be turning the corner a little bit from just month over month declining. So we saw that positivity. The economy appears to be digesting higher interest rates. And, we're going to see if, again, the self-inflicted wound for the next few weeks. And then obviously Bloomberg right now, that Biden is confident about reaching a debt deal as he heads for Japan. A key note on that is Biden did say he is going to be coming back sooner than later to resume and get back into the debt ceiling discussions here in late. So that's positive. Markets took that earlier this week as a positive. In fact, as soon as he made that announcement, markets started rallying earlier this week. Here's a U.S. home builders sentiment improving now in numerous regions. So we have the Northeast, we have the Southwest, and the Midwest. And what you're seeing is that you have a little positive, little upticks here and there. The West maybe not so, the Northeast a little bit downturned, but for the most part, the sentiment for the National Association of Home Builders, it has bottomed and is positive in all four quadrants that we just saw. Now, the U.S. home prices are declined, but it's concentrated, right? So if you look at the whole U.S. as a whole versus the diversification and location, as we're seeing, ultimately, Miami. If you're in Miami right now, you're looking at a year-over-year 10%. So Miami, Atlanta, Charlotte, those are all positive. But if you want to look at the negatives, I don't think this is a surprise. You've got San Francisco is down 10%, Seattle down just about 10% year-over-year declines, and some of the other places like Vegas and Phoenix down a little bit. The Los Angeles, they're down about 2.5%. Those are averages, right? So you take the everything that you're looking at, but there's obviously decline in the West, and some cities are getting hit even further. So if you're looking for a bargain, you could go to Seattle, you could go to San Francisco, and I'm sure there's plenty of opportunities there. But if you're looking to pick up a bargain, it's not going to happen in Miami anytime soon, because it's a super hot market that we're seeing. Now, what the Fed is trying to do, and obviously the interest rates, by basically pumping the brakes on the economy, slowing them down, raising interest rates 10 times to over 5 to 5.25% of the Fed's fund rate, is ultimately this. And we've talked about this several times here, and that's the JOLTS report for the U.S. And so what they're trying to do is close the gap between the JOLTS. Remember, that's the jobs opening. There formerly was 2 jobs open for every one person looking for employment. Now that ratio is down to 1.6, but it's also trending lower. And that's exactly what the Federal Reserve is trying to do without wrecking the economy or breaking something in the system. And ultimately they did with the banking, sort of small regional banks earlier. So this is the key to watch as we're paying attention to. And the gap, when we talk about the gap, is the unemployment rate. This needs to tick up. Now, no one wants to see anybody in the U.S. economy unemployed. In fact, there's healthy economy still underneath right now, as we can see by the employment picture playing out. But ultimately, this trend needs to continue, which is the job openings. We want less people hiring. So there's a sort of opportunity here. And then unemployment to tick up. And as that gap closes, that's going to release wage inflation. And that inflation is entrenched in sort of the corporate America balance sheets or the small business owner balance sheets. But between you and I, it's all about what we talk about Blanke Schein Wealth Management is CPIU, right? What you and I are spending money on, healthcare, education, obviously the food and groceries, they're all double-digit rates of inflation year over year. In our plans for financial planning at Blanke Schein Wealth Management, we spend a lot of time having a higher or an elevated, we've done this for years, inflation rate, because what you and I spend money on, it's in the double-digit rate of return category. That's why we need to have our assets ultimately work to stay ahead of inflation. So ultimately, even though the Federal Reserve is trying to close the gap on wage inflations, average, middle, everyday Americans still need higher wages to basically live their basic lives, and that's an issue. Now, a greater issue is the debt ceiling, which ultimately has a lot of spending in there, and the spending of the U.S. government is also adding to the inflation picture. Think about the unspent COVID dollars that are still out there. Part of the Republicans' sort of approach in this negotiation process is to say, hey, listen, all of that money that's basically been appropriated and passed, and it just shelved billions of dollars, let's just not spend that anymore because COVID has been officially over, but there's a lot of more money out there that could be sort of doled out. If so, then that's, again, going to cause sort of more of an inflation problem. But now, are we looking down, as I said before, to a self-inflicted wound? Well, for the past 40 years, the debt ceiling has always been used by the minority party to gain policy concessions that they normally wouldn't get because they're not in power. And ultimately, this has been true. So if we look at the analogs of history, speakers Tip O'Neill and Nancy Pelosi, they got more spending under Presidents Reagan, Bush, and even Trump. And then Republicans were able to secure spending cuts when they were under Clinton and Obama. So Democrats were even able to get sort of George W. Bush to break his no pledge no new taxes pledge in 1990, and that was obviously politically devastating to him later on. So this isn't, if we look at history as a guide, this is sort of normal politics, almost table stakes when you're the minority party using leverage in this case, because normally no one's going to come together and you're going to use the emergency to do it. And our experience is that these negotiations ultimately fail before they succeed. So don't be shocked by, a vote or a compromise, or somebody said that the deal's done, and then, 6 hours, 12 hours, 24 hours later, they agree to disagree and something fails. That is the political theater that we're ultimately accustomed to. I think markets are expecting, and we're expecting that as well. But we also expect, they're going to hammer out some details, and ultimately they basically use especially the emergency to get things done. And we also looked at, most recently 2011, 2013, and those are historical analogs that looked at the most similar circumstances that we're currently in. And here's what's important, is that the Treasury, if you go back to the Federal Conference call in 2013, when things were getting a little bit heated, emergencies were taking place, again, this is when the Treasury said that principal interest payments on Treasuries would continue to be made on time as maturing securities would be rolled over to new securities and interest would be paid out to the Treasury General Account. That's back then, and the decision would be made in terms of prioritization of spending. Should Congress fail to raise the debt ceiling, and the government would have enough money for Social Security, Medicare, defense, and interest. Could be a little bit different this time because obviously, Treasury Secretary is spending down the the Treasury General account, and then the tax collection in May wasn't as robust as they needed. So we are basically running on fumes in the next couple of weeks. Now, what's the timeline for this June 1st debate ceiling increase? Well, ultimately, it's starting obviously this week, and it goes all the way through. If the conversations and the talks continue and they progress procedurally, by June 1st, the president could sign into law and ultimately just move along. Now, why are we so confident that something at some point in time, maybe not by June 1st, but sooner than later, will get done? Simply because if you go by history, President Obama and Biden's approval rating 90 days prior to the debt ceiling back then, ultimately, this is Obama's approval rating, going back to when he was president and the debt ceiling was sort of, again, in the forefront in negotiations. And it doesn't actually help the sort of incumbent, if you will, who wants to run for re-election. Again, this is an election cycle. This is fully aware in Washington, and that's where everyone's using the political football. And Biden's approval rating is down here in the red, and it's trending towards sort of the D-Day. And the D-Day here is what happened historically with Obama. It sort of continues, maybe 20, 30 days, past the deal, the debt, crisis and deal getting made back then. And then it just ultimately continues to then rise as we get past summer and debt ceiling debates. Ultimately, this is the same game plan, and so you just can't have a continued slide of approval ratings, because that's not going to bode well at the polls for the following year. So I think Washington, the White House, everyone's fully aware of sort of what's at stake, and trust me, I don't believe that they're spending the time worrying about the prioritization of Social Security payments or Medicare payments. I do believe they're spending a lot more time on this slide and the conversations of what 2024 look like and the implications of that. So therefore, I believe a deal will get done as a result of this, because politically, you don't get reelected if your approval rating's not where it needs to be. And you don't get reelected in Congress if you don't give something to your constituents. So everyone's got to give a little bit to save face. And Washington does what they do best, which is invent an emergency or use that emergency and then ultimately get something passed so that they can go back to their constituents and say, hey, look what I did. I'm working for you. I'm spending more money and spending more money of our taxpayers' dollars. Hopefully it's just done properly, correctly, and with proper intent. So that's our update for today. We're going to have a lot more on this, I assure you, over this weekend. But thanks for watching. Like, subscribe, share with friends and family, and stay fully educated and informed on what's happening, what we're watching at Blanke, Schein Wealth Management. Take care and have a great day.